Welcome to a Brit of FTSE Love with me, Liam. Today we're going to be looking at Hollywood Bowl as our first company, a UK listed company, to whom we're going to give a little bit of love and a shout out, and we're going to have a look at what they have to offer. Let's walk through this. Okay, so how am I going to be scoring this? So, top place with 5 stars, it'll be classed as spiffing. Next up, we've got Splendid with 4 stars. 3 stars is I don't dislike it. My non-British wife used to hate it when I say this. It means just what it says. I don't dislike it. It's okay. 2 stars is bloody hell, which is very appropriate, I think. And 1 star, and I'm only going to reserve this for the worst of the worst British companies because I'm really here to give some love to the British companies. But if they betray that, then there's only one thing for it. 1 star, French. So let's have a look at this stock, and then I'm going to give you my opinion about where it ranks currently. Before we move on though, and for full disclosure, I do have a holding in Hollywood Bowl Group. They represent about 2% of my portfolio. There's 416 shares. I'm in at an average price of 195 pence. Started buying when they were in 180, and I've just been averaging up a little bit since. I don't think I have enough clout to move a FTSE 250 company or enough followers on YouTube, but full disclosure, I think it's important to be transparent. I suspect a lot of the FTSE companies I'm going to be looking at least in the short term, are going to be my holdings, so I'll just make sure I'm clear and transparent on what I actually own. Okay, that put aside, let's have a look at the company. So the company that we're going to be looking at is Hollywood Bowl, ticker BOWL. And this is a company I didn't really know much about before I started investing, and weirdly enough it was a company that I heard about from a Discord conversation, so which is maybe one up on a Reddit recommendation, but you know, some people have made good money on Reddit recommendations, so let's not judge. Now, Hollywood Bowl is a UK-focused leisure centre. It derives half of its revenue from bowling and half of its revenue from on-site catering and arcade centres as well. And honestly, when I started to look into this company, it was just amazing to me how much money it was already throwing off as a fairly small business. Its market cap, as you can see here, is just 370 million even at the moment. And like most retail stocks, it's had a pretty rough year. It's fairly new to the market. It only listed halfway through 2016, as you can see here. And like most stocks, it had a COVID-induced crash, went all the way down to 70p. But you know, it is recovering and managed to open up its sites for a little while last year, and just about managed to make a small profit last year because of it. So, but it's going to be a struggle for a little while, and as a result, it's still trading much below its all-time highs, although that is only 5 years. And I just really want to give a bit of love to this company because I really like it. So we'll start first of all with the dividend yield. It was already 3%, but at the moment it's not yielding. It's stopped dividend in 2020 for fairly obvious reasons. And its financial year runs from September to September. So the latest year, which was September 2020, it did manage to post a small profit just because it was open for half of that year. So that's pretty great. But you can see recently, actually, sort of in expectation that the UK might be coming out of lockdown, it's been on a bit of a tear. I picked this up as one of my first stocks in either late November or very early December. But over the last 6 months, it's up 61%, and you can see there. I mean, if you brought it on at the low at 70, you've already more than 3x your return, so free bagger at the moment. So, but I personally believe there's still a bit further to go, and I'm going to explain why. Okay, so these are the financial results since 2016, which is when it came to the stock market. Hollywood Bowl is on the FTSE 250, so not the main index, the FTSE 100, but the next 250 companies behind it. Last I looked, you needed a market cap of about 3 billion to make it onto the FTSE 100, so nowhere near actually. But I still think there's quite good money to be made in the FTSE 250, and also as well, the FTSE 250 tends to be much more UK focused. So if you want to play on that, or you don't want to worry about currency fluctuations, then that you can get some good, interesting companies in there. And if we start with revenue first of all, so this is a fairly conservatively run company, I would say. It took a couple of decades to grow to 104 million, but you can see actually some really great revenue growth until COVID. And you can see here, this is really the result of them being closed for half of the year. Now, if you take a very simple bit of maths and double this, you're looking at maybe 160 million, but they're even more bullish than that. They were in the financial results, which we'll have a look at in detail shortly. The company itself was saying that when they were open, they were seeing a 66% increase at new sites and refurbished sites, and they're very excited about this, as I think we should be as well. They managed to still have an operational profit there. This isn't quite as good as it has been in previous years, just because of the cost of sort of scaling up, scaling down, responding to lockdowns, etc., etc. But still solid. Then they've got the net interest here, so the other cost effectively financing that, and then the profit before tax. So, like I say, managed to eke out a profit even in the current year with all the lockdowns, etc. But again, you can kind of see here that they really started hitting their sweet spot from 2017, where you're looking at high teen percentage profits. And again, this is growing as well at a really lovely pace. So sort of for every 10 million that they're adding here in revenue, they're adding another 4 million in profit before tax. So it just, everything to me is moving in the right direction. And generally speaking, I just think its numbers look solid, even with the challenges of COVID. Now, that's their income statement. I'm not going to give too much thought about 2020. I think we all know what's going on here. And it really will depend, if you really love this investment or not, how strongly you think the company is going to bounce back once the UK economy opens up. I think that's a key part of valuing this company. If we move on to the balance sheet, most of this is fairly good. But you'll notice here that the assets at 183 million have a huge jump, and you might be thinking intuitively that was caused by an acquisition, but actually what it was caused by was a change to the accounting rules, similar to how the Americans have GAAP earnings. In the UK we have IFRSs, I think International Financial Reporting Standards, and Hollywood Bowl moved on to version 16 or number 16 of IFRSs, and what this meant is it sort of changes the way that they have to account for both assets and liabilities. So there was just a big jump, and you'll see when in the liability section that this is reflected down there as well. So nothing untoward. It doesn't actually signify a huge expansion at all, although they are opening sites, but not 4xing in a single year. And likewise as well, when we look at the liabilities for this, that doesn't mean that they've taken on huge amounts of debt at all. All this is basically a paper transaction. So I would encourage you actually to almost ignore this, but whatever, it's in there anyway. And if we scroll down to what we really want to be seeing as the current assets here, you can see that they're still pretty well capitalized at 20 million pounds cash in the bank. It has been gradually going down, but you can see it's at a solid level for a company of this size. I have no concerns there. And the total assets being 290 million, sorry. And then the liabilities also here with the borrowings, the 183.23. This is the committed leases, so what they have to pay over the length of the leases for the sites that they're running. So 183 million versus the 183 up here. So we can more or less just wipe those off. Like I say, it's a purely accounting contra, I think is the official word, and we can then get a much better underlying picture here with the net assets being 74 million. It doesn't have a ton of assets, but again, enough for a business of this size. And and overall, again, here we can have a look at the capital and reserves, but there's to me it's a pretty solid situation. And yes, we did see a drop from last year, but nothing too untoward. If we now then have a look at dividends, again, so they were new to the market in 2016, but then 17, 18 and 19, they start doing so well that they actually introduce special dividends in the 3 years here. Now, as a UK company, it's very standard to have a final and an interim dividend. This is something that a lot of UK companies do, especially more UK-focused UK companies, who will have an interim and a final, and typically the final is sort of anywhere between about 60 and 75% of the total, and then the interim is the other. And effectively what they were doing here is almost doubling their final dividend, and what that meant is that they're sort of yielding around the 3% mark, so pretty solid. Actually, this is quite modest for a FTSE 350 company, both the 100 and the 250. They tend to yield in the high 4%, just a different type of business, and a lot of the index weightings for the UK indexes are sort of mining companies, oil companies, so they throw off money in good years and can have higher yields. But as I mentioned in the introduction, they didn't pay any dividend last year. I don't think that's too unreasonable at all, and realistically I don't expect dividends to return until sort of the latter half of 2022, probably 2023 at the earliest. So if that's a concern for you, then it might not be for you, but just as it is, I do suspect that once they are back there, there is a solid yield here at this company, and as they grow, I think that you'll have a great yield on cost moving forward. But you can see it's sort of settled around the 3%. That's sort of what I would like them to maintain going forward, because I do also want them to keep a reasonable amount of money to expand. And you can see here as well the dividend cover is ×2. This is something that in their financial reports they say they'd like to stick to. So effectively switching this around is a 50% payout ratio, which again I'm perfectly fine with, sort of a stable-ish but growing business as well. So I think this is a well balanced from that scenario. So moving on to valuation, now I actually think this company has a reasonable amount of its upside already baked in. It has risen from about £2 relatively recently. It was as low down as 70p. I personally am targeting a short-term target of £2.50. I'm continuing to average up my stake. My average buy price at the moment is £1.95, as mentioned. So yeah, I'm happy to buy in. To me, I think for the next sort of 9 months, probably until we get a better idea of their year end, what it looks like, is going to cap this around the 250. So Simply Wall Street here is one of the more generous pricing I could find from analysts. If we have a look at a broader range, just over here, we can see here sort of analysts for the next 12 months are anywhere between sort of 210 and 270. I think 210 is really pessimistic. I think the business has shown some great responses to COVID, which we'll walk through in a second. And I do think 270 maybe a bit optimistic in 12 months, but maybe if they have a great financial year end or they really bounce back strongly, I don't think that's too unreasonable. And for me personally, when I look at this business, I'm targeting a 400p over the next 3 years. So I'm sort of looking for 100% return, more or less, over the next 3 years is my target here. So this is a consensus rating of 7 analysts. So make of that what you will. Now, in terms of reopening after COVID, 17th of May is scheduled for all of the England sites. This here is a map from their website, and you can see most of their sites are in England. Sort of, you can draw a line here, and this is Wales. And then if you just scroll up here, you've got Scotland up here as well. So most of these, 4 in Scotland, 2 in Wales, but most of these are going to be opening on the 17th of May. So it still gives them 4 months to make some money before it comes in. But I am expecting a loss this year, to be perfectly honest. You can also see here as well, they've started to open 3 golf centres. So this is one of their expanded ideas. And even during 2020, they managed to open another 4 sites. So pretty great and surprisingly good. So they currently have 64 sites if you include the Putt Stars here. Most of them are under the Hollywood Bowl, and then they have a couple of AMF centres as well from sort of legacy purchase that they haven't rebranded, but I don't think there's any rush to do those from what I can see. My local here, actually, the O2, I can actually sort of see it from my flat, so very close to me, so that's nice to see as well. So yeah, once most of these centres reopen on the 17th of May, general feeling in the UK is that there's a lot of pent-up demand for leisure, and I really think that sort of a fun family outing like Hollywood Bowl, it's also fairly good in terms of protecting from COVID. You have your own lane, you're reasonably safe. I think Hollywood Bowl is well positioned to recover reasonably quickly, which is also how management feels. But let's have a look at the numbers now, and on Hollywood Bowl's own investor site, which is where I'm currently getting this information from. So I've actually spent some time looking through the 30-page annual summary. Something that occurs to me is that I'm almost certain that this business has what's called an OGSM business model, which is what my employer has. So objective, goals, strategies and measures, just because when they talk about a lot of these things, you can sort of see how they're positioning it. They're super conscious on customer focus and team culture. They're renovating a lot of their sites. They plan to do a lot more this year as well. Evidently that leads to higher margins, and that can only be good. I did like this as well when I was doing my research about the diversified revenue streams. Again, half on the bowling and half on amusements and food and drink. When we talk amusements, we're talking sort of penny machines and arcade machines, etc. So it's got that slightly nostalgic feel, but I really like the brand, to be perfectly honest with you. When they look at further growth, it's sort of a combination of opening more sites, increasing spend per head. That's something that they've been doing already during 2020. It was up 5%, so that's pretty great. And also encouraging sort of longer spend of wallet, so you don't just go in to play bowling, you also go bowling, don't know what the right word is, but you don't just go in to bowl, you also go in for lunch or maybe have a drink and etc. So really kind of making it a more leisure experience, which again I think is a great idea if you can build up on that. In terms of the financials, so like for like here, they use this abbreviation a lot. So the revenue growth was only up 0.4%, but considering how much the sites were actually closed last year, I found that pretty remarkable. Compared to 2019, it was 5.5%, but I really expect next year, partly on soft comparisons, that's going to bounce back in a huge way. Revenue still held up reasonably well, 80 million quid against 130, considering it's spent half the year closed is no bad thing. You can see here as well the average spend per game. This is what I'm talking about in terms of the rising revenue. And again, profit after tax, 1.4 million profit across last year. Nothing compared to 2019, of course, and that gradual accumulation of net profit, but still pretty impressive. And again, profit margin here for this is gross profit margin effectively. This has seen a big drop, but again, if you were to read the investor report, you'll see that it's sort of to do with some more wastage, some costs that they weren't able to get rid of as they sort of constantly had to try and open and close centres, etc. So I don't think this is indicative of long-term profit at all. In terms of EBITDA, so again, I still think this is pretty okay. They did do some accounting magic to come up with this number. I'm personally much more interested in the 1.4 million. The dividends since IPO, so 5 years ago, is 50 million. Not bad. That works out, as we said, sort of 3% for the last few years, except from 2020. And again, here the earnings per share very modest, especially compared to last year. But still, the fact that we're seeing those is pretty great. So here they're talking about new centres. The pins on strings is sort of to make the operational efficiency even faster. So even like little marginal improvements like that is pretty great. There's some nice stuff in here as well about how they're repositioning. They've improved their credit facilities with their bank. They've negotiated rate reductions and rate holidays with their landlords, and they also did an equity placing as well that was well received, partly because they want to be using that equity placing to buy distressed sites and opportunities that might come up. So again, I'm personally a big fan of this, to be honest with you, and I think it's impressive the way that they've been able to pivot during the year across those various areas. So like I say, reading through this, I think it's a very credible story in my opinion, and I'm totally on board with it. Now, I'm not going to take you through 34 pages of their annual results. This is already long enough, but I just wanted to highlight two things that are worth highlighting. So first of all, free cash flow. In a normal year, they're throwing off £15 million, and they're very generous with their dividends as well. From this regard, they use their own capital for expansion, or have been at least for the last few years. Now, debt has risen to £8 million, but again, I'm not particularly concerned just looking at the free cash flow numbers, and assuming that this is going to return to 15 million, they're going to take 1 or 2 years to pay that down, but I'm not overly concerned by that. I would just sort of temper my expectations for dividends, because I expect them to be reintroduced not as a big bang at 3%, probably sort of in the 1 to 2%, and then gradually scale up while they pay down their debt. Historically, though, it's a very conservatively run business, so no issues, I don't believe, taking on a little bit of debt just to take them through this period. And as you can see, the asset to debt ratio is fully covered, and so I have no concerns there. But I do think that is worth considering as we wonder whether to buy this or not. Okay, so after much thought, I'm going to give this a ranking of splendid. It's not quite good enough to be spiffing. It does have some concerns. The centres haven't been open for much of the last year. It's had to take on some debt. Refurbishment is slower than I'd like it to have been as a result. Not their fault, of course. Expansion, likewise, has been probably pushed back a solid year. But this is an exciting company. I expect dividend to return in the next 3 years tops. Again, another reason at the moment why we can't give this a spiffing, but it's an appropriate prioritization for the company. I don't think it's right to say I just don't mind it, because I think it does have a lot going for it. I do think there'll still be some modest capital appreciation, and I think a big window is going to be coming up to their September year end, so that's definitely something to pay close attention to. But I'm really bullish on this. A lot of whether you want to buy this or not is of course up to you. Please do your own research, all that other good stuff, but a lot of the decision making is going to be whether you think there is a credible growth and recovery plan here. And honestly, if you do feel the same way I do, and I do think there are those things, then it's a great buy even at today's prices and a long-term hold in my opinion. So this has been my first UK stock review. I hope it was useful for you, and please leave likes, comments, and ideally subscriptions. They're always welcome. Thanks very much for joining me.